overhang just got removed. That's the exact setup that historically produces asymmetric returns. The crowd is pattern matching. Meme coins are dead. The same way they pattern match Bitcoin is for criminals in 2015, and the internet is a fad in 2002. The revenue is the tell. Dead things don't do 40 million a month in their worst year or month. Here's the buyback breakdown. What's happened so far? 332 million in total buybacks since July 2025, roughly 8 months. That's removed 30% of circulating supply. 105 billion pump tokens bought back, representing 10.4% of the total supply and 30% of the circulating supply. 100% of daily protocol revenue now goes to buybacks. Let's go open that up because we need to dive deeper into that. Daily buybacks averaging 1.525 as of February 2026. The math going forward at 1.25 million in buybacks and a current market cap of 1 billion, Pump Fund is buying back roughly 3.6% of its market cap every month. That's 44% per year at current rates. At this pace, over the next 12 months, they buy back another 456 million in tokens. That's roughly 25% of the current fully diluted value being absorbed in a single year at the floor revenue. How this changes the effective FDV. Right now, 1 trillion total supply, 1.8 fully diluted value, but 105 billion tokens are already bought back and locked. If you back those out, the effective circulating FDV is closer to 1.5 to 1.6. In 12 months at current pace, another 200 billion tokens get pulled. You're looking at an effective float that keeps shrinking while the revenue floor holds. The revenue buyback ratio is the key number. Buybacks have tracked 99.5 to 100.5 of the daily revenue. It's nearly 1-to-1. Every dollar the platform earns goes right into token absorption. No other protocol in crypto runs this aggressively. The comparison that matters. Hyperliquid does the same thing, 97 to 99% of revenue to buybacks. But at 36.5 fully diluted on the 696 annualized revenue, Pump Fund does it at 1.8 FDV on 468 annualized. Hyperliquid's buyback yield is 1.9% of FDV, while Pump Fund's is 25%. Now do one last short, concise comparison, Hyperliquid versus Pump Fund. And based off of what we've looked into today, what is the winner? Just curious what she thinks. Obviously, I have my bias. Put differently, at current revenue, Pump Fund buys back entirely FDV in 4 years. Hyperliquid takes 52 years. So it would take Pump Fund 4 years at their current rate to buy back the entire token reserve, 52 years for Hyperliquid. If meme coin activity returns to even half of its peak, Pump Fund compresses that time to under 2 years. The July 2026 risk, a major unlock, is scheduled for July 2026, 1 year post ICO. That's the event to watch. Between now and then, buybacks will have absorbed another 450 million in tokens, which creates a cushion, but the unlock will test whether the buyback wall can absorb new supply hitting the market. Bottom line, at bear market revenue levels, the protocol is eating its own float at a rate almost no one in crypto can match. If revenue even stabilizes here, the shrinking supply becomes the dominant price driver over time. So a Hyperliquid versus Pump Fund here, head to head. Fully diluted value, 36 billion versus 1.8 billion. Year one revenue, 844 versus 321. Year two, 664. They're both declining, so this isn't a fair. But current annualized revenue, this is more like it. So current annualized revenue is taking last month's revenue and multiplying it by 12. Hype, 700 million. Pump Fund, 470. I think this is the last point I need to make here is what market do people have a higher chance of winning in? You know, us quants can get off with trading bots on Hyperliquid, but I'm speaking hand traders. I would argue there's exponentially
it's
more
what's called
millionaires
machine learning
made off of Pump Fund
So you find
than Hyperliquid.
things
You get liquidated
that
on
are
Hyperliquid,
predictive.
you don't
You might guess, oh,
on Solana memes.
such and such should be predictive, might be predictive, and you test it out in the computer, and maybe it isn't, maybe it isn't. You test it out on long long-term historical data and price data and other things. And then you add to the system this if it works, and if it doesn't, you throw it out.